This is Dr. T. Varalakshmi discussing you about the features of capital budgeting proposals as a part of business economics and financial analysis. Capital budgeting, the planning of future long-term expenditure of the business is called as the capital budgeting. The previous video I have discussed more elements on this capital budgeting. Now in this one, how to choose the proposals and steps involved in this capital budgeting decisions is going to be discussing in this one, because the crux of capital budgeting is profit maximization. The main aim of this capital budgeting is profit maximization. So it can either through the increasing of the revenue, that is, if they can increase the sales, they can increase the profits, or if they reduce the cost, or also they'll get the profits. So that's why in both the balancing of the increasing revenue and reducing cost are going to be giving benefits to the organization. That how to increase that revenue and how to reduce the cost will depends on the well they are all planning and the well they are all organizing and implementing and forecasting of future cash flows. All these accumulated steps are all included under the capital budgeting decisions. So that's why the capital budgeting decisions are all categorized into three elements: whether to accept the proposal or reject the proposal. For example, if they have chosen to invest into the land or at one place and second place. First of all, choosing of the purchasing of the land is a project, and they want to purchase the land either in the location 1 or location 2. So they have to accept either one or two, reject the another one. On which basis they will accept and on which basis they are rejecting should be a proper evidentive nature. That's decisions are all taking with the help of this capital budgeting. And sometimes these projects may be related to the another elements, that is mutually exclusive project decisions are all there. So because of the purchasing of that land, compulsory they need to establish the plant. Either one place or second place they have taken. So they are compulsory, they need to establish that plant, because that is a mutually exclusive project related to that first project, land purchase. So what with the minimum cost, how to establish that plant is again taking with the help of this capital budgeting decisions. Then if the plant is established, and what kind of the machineries they have to include, and what kind of the infrastructure they need to maintain the rationale of the capital decisions is also a part of this capital budgeting. So the capital budgeting decisions will include either accept or the reject rule, mutually exclusive project decision, or the capital rationing decisions. So before going to take this capital budgeting decisions or the accept or reject, certain factors they need to take into the consideration, that is the capital structure. Like, what are the sources of the organization? If the organization is having the high debt capital or the low debt capital, high equity capital or the low equity capital, that combination of equity and debt capital is called as the capital structure. If that organization is having high debt capital, means compulsory they have to get the profits, because they need to pay the interest rates to the debt holders. They have got on that basis. But if they have the equity capital more, then they can take more risk. That is, they can invest into the land, because even if the loss occurs, that is going to be sharing among the shareholders. So that's why, based on the capital structure, these capital budgeting decisions will be decides. And not only to that one, and their earning capacities. If their earning capacity is more, then the capital budgeting will be more. And if the earning capacity is less, then they will control over the expenditure of that long-term activities. And their accounting methods. So what kind of accounting methods they are using? What is their fund flow, cash flow methods? And that is going to be deciding this capital budgeting. And objectives of this capital budgeting is the objectivity of the capital budgeting is the revenue generation basis or the cost control basis. and amount spending for the day-to-day activities are also required for that one. Based on that one, they can plan how much of amount they can allocate for the long-term activities. And lending policies of the financial institutions, on which basis they are taking the loan from these financial institutions, and how the government policies are all there. And capital expenditure control, if any, if they are spent, can they control or not. Capital returns, and what is the way of getting the returns from that one, and what are the management decisions, and management's opinion towards that expenditure, their taxation policies, and selecting profitability projects, and availability of the funds present with that one, and project needs and project economic value, is it really beneficiary to the organization or not, and finding the right source of the finance. These are all the knowledge elemental factors should be considered by the financial manager as a part of capital budgeting. There are certain steps are all there under the capital budgeting process. The 6 steps involved in the capital budgeting processes are all. First of all, they need to identify where has to invest. Then, once they have identified, they need to evaluate the investment proposals. So that is, they have identified 4 investment options. That one, what is the cash inflows and cash outflows of all these 4 elements and 4 options. That is called as evaluation. Based on that one, they need to take the best decision by considering the factors of the capital budgeting. And once if they have taken a decision, then they have to decide the apportionment, how much of amount they need to allocate. That is called as allocation. And once it has done allocation, they need to start the work under the concept of implementation. Once the work has done, finally they need to review as per their expectations, it is coming or not, has to review under the performance review. So these are all the precious steps involved in capital budgeting decisions. The first step, if we take into the considerations, that is the proposal identification. Consider emerging or alternative markets are all there. So various markets are all there. A good tip to begin is a simply expansion of the every business activities investment horizon. So based on the market opportunities, if they choose the best investment proposal, there is a scope for getting maximum benefits to the organization. To identify that one, brainstorming is required, and experts' opinion, market conditions, demand estimations, demand forecastings are helpful to the financial manager at a high level. Once a project is identified, the next thing is evaluation of that particular proposal. That is, what are the cash inflows of that one, cash outflows are of that one. That is, how much of investment they need to presently invest, and how much expectations will be there with that investments in the future, that they have to analyze. And estimation of the required rate of return, that too, at what rate they have to get the returns. At if 50% rate get returns they will get, then only that proposal is acceptable, or the decision rule on which basis they are making that one, that application, everything has to take care under this proposal evaluation thing on calculation basis. The third step is, once they have taken various proposals and they have evaluated, now choosing the best among these evaluated ones is the key factor. That is the investment decision. That investment decision should be taken by the management team based on market opportunities and use of that proceeds. If they invest, what is their use? Is it really going for the growth perspective or not? And when compared to the competitors, it is going to be giving the benefit or not? Strategically, is it a beneficiary or not? Technologically fit or not? And how to exit if any losses will come? What is its impact? That decision is going to be taken by the management team as at the third step of the capital budgeting. So once the decision is done, then they need to allocate that funds. That is called as apportionment of that funds. So once they're selected, so what are the needs of that funds, finding the needs of that project and sources of the funds to acquire that funds, and allocation of that funds, either in the form of the long term, short term, equity, debt, has to think about the business financial manager as a part of the capital budgeting process. The fifth step is implementation of that plannings, what they have done based on the vision. They need to fix some visions, strategies, implementation processes like deadlines, accountabilities, ownership, monitoring system. So if they have planned everything, that will be called as implementation stage. So that is once the decision has done, and acquiring of the plant and machinery, fixing of certain targets for that investments, everything is included under the implementation. The last and important steps involved in the capital budgeting is performance review. Once they have invested and they have done the work as per their expected things, is really they are getting that one or not, getting the feedback from this results, rating, comments, surveys, opinions, response, ideas, advertisers, as well as the beneficiaries which is gained by the organization, as per the expectations they are getting or not, and as per the plannings, are they really it is occurred or not, and overflow is there or the underflow is there, everything has to analyze to so that they can add more beneficiary elements in the next future investments. That is called as the performance review. So that's way. So these are all the 6 various important steps that a financial manager has to follow to choose the best investment opportunities as a part of this capital budgeting process. For this capital budgeting process, the financial manager will utilizes some of the techniques called payback period, post payback period, average rate of return, net present value method, internal rate of return method, and profitability index methods. So that techniques and everything we'll have the discussion in the next video. Thank you all of you.
Like, share and subscribe. Hit the bell icon for more updates.